You pay your bills on time. You don't have massive debt. You think you're doing everything right. But then you check your credit score and it's stuck. Or worse, it dropped 20 points overnight for no obvious reason. Many people with average or even good credit aren't making big mistakes. Instead, they're being quietly penalized for small habits they don't even realize matter. It's frustrating, isn't it? You feel like you're playing a game where the rules are hidden in an invisible rulebook. Well, today we are opening that rulebook. Everyone knows missing payments or bankruptcy destroys your score. We aren't talking about those today. We are talking about the silent assassins, the 5 sneaky, counterintuitive financial habits that are actively dragging your credit score down right now without you even realizing it. And this, your credit score, affects almost everything in your financial life. By the end of this video, you'll know exactly how to stop the bleeding and start seeing that number climb. Let's get into number 1. Point number 1, the statement date trap. This first one is the most common reason financially responsible people have mediocre credit scores. You think that as long as you pay your credit card bill in full by the due date, your score is safe. You are wrong. Here is the secret mechanism. Your credit card issuer takes a snapshot of your account balance once a month. This is usually on your statement closing date, not your payment due date. They send that snapshot to the credit bureaus. Let's say your statement closes on the 20th and your bill is due on the 25th. You rack up $2,000 during the month. On the 20th, the bank takes a picture. You owe $2,000. They tell the bureaus you are using a huge chunk of your available credit. Even if you pay that $2,000 off completely 5 days later on the due date, the damage is already done. The bureaus have already recorded high utilization for that month, which can tank your score. The fix: find out your statement closing date. It's on your bill. Pay off your balance, or at least most of it, 3 days before that closing date. When the snapshot is taken, your balance will be 0 and your utilization will look pristine. Point number 2. The tidy up mistake, closing old accounts. Number 2 is what I call the Marie Kondo mistake. You decide to tidy up your finances. You find that old credit card from college you haven't used in 5 years. It has a 0 balance. You think, I don't need this, I'll just close it to be organized. Stop. Don't do it. Closing that old account silently destroys your score in 2 distinct ways. First, it hurts your average age of accounts. FICO likes to see long-term relationships with lenders. That 10-year-old card is anchoring your average age. Close it, and suddenly your credit history looks much younger and riskier. Second, and more immediately, it destroys your utilization ratio. If you have 2 cards with $5,000 limits, you have $10,000 available credit. If you owe $2,000, your utilization is a healthy 20%. If you close one of those cards, your available credit drops to $5,000. Suddenly, that same $2,000 debt means your utilization spikes to 40%. Your score drops instantly. The fix: if the card has no annual fee, keep it open. Put a small recurring subscription on it like Netflix, set it to autopay, and throw the physical card in a sock drawer. You keep the history and the credit limit active without the temptation to spend. Point number 3, the nice guy syndrome, cosigning. Number 3 is perhaps the most emotionally difficult one. It's destroying your credit score because you're trying to be a good person. You co-sign a car loan for your child or an apartment lease for a sibling. Listen to me closely. When you co-sign, you are not just vouching for someone. You are legally taking 100% ownership of that debt. Most people don't realize that this loan now appears on your credit report just as if you took it out yourself. That brand new $40,000 truck your nephew bought? That's now $40,000 of debt sitting on your debt-to-income ratio. It gets worse. If they miss a payment, they don't just ruin their credit, they ruin yours. You likely won't even know they missed the payment until you get a collection call or see your score plummet 80 points. The reality: never co-sign a loan unless you have the cash sitting in the bank to pay it off immediately and you are fully prepared to do so. Otherwise, you are handing the keys to your financial reputation to someone else. Point number 4. Incorrect rate shopping. We are told to shop around for the best interest rates on mortgages and cars. That's smart advice. But the way people do it is secretly hurting them. Every time a lender checks your credit for a loan application, it's a hard inquiry. These usually knock a few points off your score. People get scared of this, so they space out their applications over months. They apply at one dealership in January, another in February, and a credit union in March. The credit bureaus see this as 3 separate attempts to get new debt, making you look desperate for cash. Your score takes 3 separate hits. The fix: you need to use the shopping window. Modern scoring models are smart enough to know when you are rate shopping for a specific type of loan. Use the 14 to 45-day rule. If you apply for 5 different auto loans within a short period, typically 14 to 45 days depending on the scoring model, the bureaus group those together and count them as only one hard inquiry. Don't space it out. Do your research, and then pull the trigger on all your applications within the same 2-week period to minimize the damage. Point number 5. Zombie nuisance debt. And finally, number 5. This is the sneakiest destroyer of all because it usually involves tiny amounts of money you completely forgot about. A $30 medical copay from 2 years ago that got lost in the mail. A final utility bill from your old apartment that you thought was paid. A forgotten library fine. These companies often don't call you, they just sell the debt to a collections agency. Suddenly, a $30 forgotten bill turns into a severe delinquency or collection account on your report. FICO doesn't care if the collection is for $50 or $5,000. A collection status is a major derogatory mark that can drop an excellent score into the fair category overnight, and it stays there for 7 years. The fix: don't just look at your free credit score app. Once a year, go to annualcreditreport.com and pull your full, actual reports. Scan them specifically for tiny unknown collections so you can pay them off or dispute them before they become zombies that eat your score alive. Your credit score isn't just a number, it's a tool. If you avoid the statement date trap, keep old accounts open, refuse to co-sign, shop for rates correctly, and watch for zombie debt, you'll stop self-sabotaging and start building real financial power. If you found these tips helpful, hit that like button so YouTube shares this with more people. And click on subscribe if you want to know the fastest way to actually boost your score once you've fixed these errors. Thanks for watching.